Tata Metaliks was probably one such number, reported about a 63% jump in its December quarter profits. What's also reassuring is the all-round performance from both its verticals. But with metal prices on the rise, will the leading pig iron makers' margins come under pressure? To answer this and to discuss the road ahead of the company, joining us now is Managing Director Sandeep Kumar. Mr. Kumar, thank you so much for joining in. Actually, let's start off with that question first. While the going seemed to be good, and I'll come to that in a bit, do you believe operational margin or operational efficiency challenges are have now come to the fore for the quarters ahead?
Yeah, so thank you for inviting us. You see, the operational results have been improving over the last few quarters, and these are the result of the structural cost reduction projects that we took up mostly in the last fiscal year. In addition to that, the regular improvement initiatives in terms of the incremental cost reduction projects that have also been launched in the last quarter, and therefore going forward, that's where the most of the cost squeeze is where we would be focusing on, and currently we are focused on. So in addition to the market, I think on the cost side, we need to be focusing much more than what we might have done over the last couple of years, and that's where we're currently looking at.
No, which is a point well taken, Mr. Kumar. I think everybody's acknowledged the fact that you have some quick payback, cost-efficient projects which have already happened. I think the question mark to everybody's mind was only that with the metal prices on the rise, will something that is not within your control, will that impact your operational efficiencies and operational margins going ahead?
Yeah, so for example, iron ore prices have risen significantly in the domestic market because of almost 15% of iron ore production being shut down in Odisha. As you are aware, the Supreme Court ruling for miners to pay up for excess mining in the past. So that is a temporary disruption, and that would impact, I would think, the steel makers in India. And I think yesterday we heard about the Goan iron ore mining licenses being cancelled. So that's one a red flag for us. As far as coal and coke are concerned, they seem to be rising, but now they seem to have coming down. More importantly for Tata Metaliks, I think it's important that we keep a control on coke, which is the primary input as a cost element for us. And from a level of 40% of our coke being captive, now we have long-term tie-ups with Tata Steel, and that takes care of almost 70 to 80% of our coke consumption. So a major part of the cost element is now under control. So it's linked to coal cost rather than both coal and coke volatility.
By the way, just an update, Mr. Kumar, this Goa ban, we understood that it was pertaining only to the low-cost iron ore, which is not used in India. Will that impact companies within India, maybe companies like you as well?
Yeah, so you're right. In India, the markets are regional. For example, we are impacted more by Odisha than by, say, Goa. But overall, I think sentiment and overall the exports, market, the international market does, impact. For example, the iron ore prices internationally have nudged downwards or have remained more or less stable in the last, say, 15, 20 days or a month. But if you look at Odisha, the prices have jumped. So, there is a dichotomy here. But in the short term, but in the long term, I think both should converge.
Let's talk about your quarter as well. Both the pig iron and the ductile iron pipe segment, how did volumes shape up, and how do you expect volumes to shape up in let's say just quarter 4?
Yeah, so the quarter 3 has been quite good, and despite significant cost increase, we have been able to increase our profitability, mainly on account of higher volumes. So the pig iron volumes have doubled compared to quarter 3 of last year, and there is an increase of over 25% in the ductile iron pipe volumes. Going forward into Q4, we think we should be able to do at least as much as we did in quarter 3, if not more. In fact, we would tend to think we should do more than that. So we are quite stable at these levels, and therefore we don't see a problem as far as the sales volumes are concerned. In any case, we get into the peak season in quarter 4, which is the January, February, March, April period.
Okay. And does calendar year 18 therefore look more solid? Because I would presume that because of GST, some of the sales would have not been normal from the April to September period of calendar year 17. Does that, I mean, was there a low base therefore, and does that augur well for calendar year 18?
Yeah, certainly. I think the impact of GST did disrupt us in quarter 2 mostly, and a little bit, into quarter 3. Going forward, as things stabilize, the calendar year 18 and FY19 should be better. But we also need to take into account that there are a lot many factors than merely demand. On the demand side, with the current budget focus of the government on water and infrastructure, that should also help the demand side. So we're looking good in terms of demand, but on the cost side, on the raw material side, it's more international driven. So it's always, difficult to say which way things will move. But at the moment, things look pretty for us.
So on a YOY basis, Mr. Kumar, for the year as a whole, just going by your commentary and going by your Q2 as well as Q3 performance, because almost everybody believed that the tough phase was over and now the things would improve for Tata Metaliks. Would you believe that you would end, I mean, is there any kind of guidance that you can give us for how FY18 will look like over FY17 on the volumes front, maybe on the overall revenue front?
Yeah, so, as a policy, we don't give guidance. Sure. But as I mentioned to you, that, the volumes are looking good, and quarter 3 volumes have been good for us. And I think there's no reason for us to believe quarter 4 wouldn't also be similar, if not better. So, at the moment, I think if you look at calendar year, the financial year FY18, we seem to be there as per our plans and as per the market expectations. FY19, as I just mentioned a little while back, the demand side looks good. Raw material will be the one to keep a watch on.
Okay. No, so just wondering, did your internal estimates, and I don't know if you have made them public or no, but did your internal estimates involve revenue growth which is northwards of 7-8% for FY18 or FY17?
So FY18 compared to FY17, there is almost an increase of I would say anything between 20% to 50% in terms of sales volumes for us. Depending on which product line talking about. If you're talking about pig iron, because one of our blast furnaces was taken down and a new one came up. So in last financial year we were hit, to a certain extent for volumes. So we expanded, therefore there were increased volumes of pig iron available this year, which will continue into the future. As far as the ductile iron pipe business is concerned, that also was expanded last year. So therefore we are going to do obviously much more, and we are doing at a rate of say almost 45 to 50,000 tons per quarter. So that's the level at which we should certainly do, if not more. So for ductile iron pipe. So
doing a revenue overall sales of about 1800 to 1850 or maybe 1900 crores would not be out of the ordinary, I would presume.
Yeah, I mean, if you just kind of project what we have done in quarter 3 and don't take into account any major deviation in the prices, the number that you are given can be arithmetically calculated. So that doesn't look very much
ordinary. Okay, fair call. Now one last question really. At the end of quarter 2, you had taken steps for coke integration. You had sought shareholders approval for sourcing about 40% of your coke requirement from Tata Steel on an arm's length basis. I mean, can you give us some details thereof? How is it proceeding?
Yeah, so it's actually helped us, because what happens is that the Tata Steel's plant is located at the port, and we went to the shareholders to seek approval for buying this coke to serve almost 40% of our requirement. This is obviously on arm's length, but what it does, it gives us predictability of quality, predictability of logistics, and also predictability of, I would say, stability of prices, because it's a long-term contract. And therefore what we have seen over the last few months, that it's been helpful to us, rather than buying coke from all over the place, different quality, different logistics, which always bothers us. So this is a much better scenario for us compared to say last year.
Okay, fair call. Mr. Kumar, appreciate you taking the time out and joining us. Congratulations on a good quarter. We look forward to talking to you post your quarter 4 numbers as well.
Thank you very much.
Thanks for joining in today.
Thanks.